I don't know if you've noticed, but everyone has been talking about healthcare the last 2 years. A pandemic might have that effect, you know. Investing in healthcare, however, is quite a difficult task, and it's something that requires some additional mental checklists as compared to other companies and sectors. As a general rule, there are 3 types of healthcare companies out there that are interesting to invest in, and you should be able to know the different characteristics of the ones you choose. Anyway, the first up is the pharmaceutical companies. Here you have your Pfizer's, Johnson & Johnson, Novartis, the big names. Out of all of the healthcare companies, these are arguably the most stable and attractive. They have returns of invested capital of about 25 to 30% if managed correctly. The reason why these companies are so attractive is because the economic moats of the big pharma are wide. This is due to the development costs and the time to get new drugs to the market. It takes between $1 to $2.5 billion and about 12 years for drugs to reach the market and start generating cash for a pharma company. If we want to include the discovery process, this can take around 20 years. Anyway, these development costs and the time is what stops smaller pharmaceutical companies to enter the market. They just can't absorb the costs over such a long time. If you're not a doctor or a pharmacist, most of the analysis in big pharma is around understanding the pipeline and the process to get new drugs to the market. I suggest digging quite deeply into how this works and understanding the different stages. I will only give you a short overview. The first stage is the discovery and the basic research. This is usually done through trial and error. Viagra, for example, was discovered by Pfizer as a side effect from an unrelated blood pressure drug. Once something has been identified, you move to the next phase, which is called the preclinical testing. This takes around 1 to 3 years, and 85% of all drugs and their applications filled with the FDA make it to the next stage. This application is called the IND, which stands for Investigational New Drug. The next stage is the phase 1 human clinical trials. This part can take about 1 to 2 years, and the main concern of this phase is the safety in healthy individuals. About 20% of these drugs make it to the next phase. The cost for this phase is usually about $5 million. The phase 2 of the human clinical trials. The scope of this study is increased to include individuals with a disease that is being targeted. This phase takes about 2 to 3 years and costs about $5 to $10 million. Around 50 to 60% of these drugs make it to the next phase. The phase 3 of human clinical trials is the most costly. In this phase, the efficacy of the drugs are being tested, as well as the long-term effects. This can take between 2 to 4 years. The costs for this phase vary a lot, but they can range from 10 to up to even $100 million. Only around 60% of these make it to the FDA approval process, which is the last phase in this lengthy process. The FDA can reach several judgments on this. It's either approved for marketing, which means the company can start marketing and selling the drug. They can request additional information or another round of testing, or denying the application completely. So the process is fairly long, and before the company can start generating any cash, it can take a long time. So it's worth to take this into account. What's important as well is once the drug has been improved, it can then be marketed and sold. The drug has a patent life of 20 years from the date of the application. However, the patent submission usually happens during the trials, which means that companies never have 20 years alone in the market. It's usually around 10 to 12 years. These patents can be found in the 10K report under patents and intellectual properties. A great pharmaceutical company is usually characterized by the following: having highly successful drugs that make up for a large percentage of the revenue. It's worth noting that this can be a double-edged sword. Once the patent is lost, a large part of the revenue can disappear overnight. So having a pharmaceutical company that manages the patent protection is very important. This is where the pipeline of drugs comes in. Having several drugs in different stages and phases of the FDA approval process reduces the risk. The marketing capabilities and the sale channels shouldn't be underestimated. Drugs with a big market potential is also important. These are drugs that target common and chronic conditions. The next type is biotechnology companies. Novo Nordisk is currently the highest valued biotech company. They have a market cap of roughly half that of the biggest pharmaceutical companies. Biotech is usually connected to higher risk than pharmaceutical companies. The difference between the two is that biotech uses live organisms and biologic to create drugs, and pharmaceutical companies create drugs through chemical processes. There is, however, a lot of partnerships between pharma and biotech, so this makes the lines slightly blurred. A great example of this is the partnership between BioNTech and Pfizer, where Pfizer stands for the distribution and BioNTech stands for the tech. The reason why biotech is generally seen as riskier is because the end result is often a completely new form of treatment and the market size is much more difficult to gauge. When thinking of biotech companies, it's often good to split the companies into established, up and coming, and speculative, and then use your risk tolerance as guidance for them. Established biotech companies can be looked at much the same way as a pharmaceutical company, with a focus on the pipeline of drugs and make sure that there is a cash flow to cover several years' worth of research costs. Up and coming biotech companies are close to success. This means that they still have quite a bit to prove and they're quite risky. Cash is very important for these, as well as their burn rate. As mentioned previously, phase 3 is the most expensive phase, so keep that in mind. Partnerships with established companies can be a very attractive options for these biotech companies, where the technology has been validated by larger players. But this can also mean that a large part of the profits goes to someone else. Speculative biotech companies have some very interesting tech on the way, but the chance that it actually gets all the way through all of the trials and the phases is so slim that it's usually not worth it. The payoffs can be huge, however. The last healthcare company that's worth looking at is medical devices. Medical device companies are more straightforward to understand for a layman than biotech or pharma companies. They make the hardware for medical procedures such as pacemakers and PPE. These companies often have a wide economic moat because physicians tend to be reluctant to switch device for another company's solution. It takes a long time to learn a specialized operation, and to change the hardware and tools is often not possible without a significant investment of time. This means that these companies sit on quite a lot of pricing power as well, being able to raise prices without too much of a fuss. An additional benefit of medical device companies is that medical devices usually see incremental improvements rather than evolutionary ones. This has two important benefits. First, it means that the FDA approval process is quicker. Improvements to existing devices goes through a streamlined FDA process. The second thing is that it also means that the risk that one company will create a truly revolutionary product that will beat the competition is much lower. In order to find outperforming medical device companies, look for the following. A strong sales force penetration, having a knowledgeable sales force that can act as a consultant as well as a salesman. Product diversification. If the company offers a mix of products with high margins, it reduces the risks significantly. Product innovation. By going through the annual report to see the new product releases as compared to the R&D spending, this sees how efficient the R&D is in the company. So, to summarize, in addition to all of the metrics that we've used to identify the financial health and the growth of the company that we've discussed in the overall video, for medical companies, we need to understand the product life cycle and the pipeline of new drugs or treatments. A key in understanding this is the FDA approval process, where the costs and the timelines of the different phases is crucial. Connected to the costs and the FDA approvals, the cash and the burn rate is an important item to look out for these types of companies. For larger established healthcare companies, the costs might not be as important, but the idea of the timelines are. For smaller and unproven companies, the cost can be the difference between life and death. And a note about the industry that I didn't really cover here is that healthcare is often something that governments get very interested and involved in. So keeping an eye on spending and regulation from governments is very important. This is especially true in the US. So thank you for listening. I hope you learned something today.